So today we are going to start our third session of ongoing playlist, which is on microeconomics, and it carries 3 marks put together as per revised IBBI syllabus with effect from July 2022. So in today's last session, first we will cover various theories of rent. As per IBBI syllabus, 3 theories are required to be covered: Ricardian concept of rent, modern theory of rent, and then quasi rent theory. Then we will also touch upon few details of interest, gross interest, and pure interest types. And towards the end of the session, we'll discuss about various theories of profit from IBBI examination perspective. We'll touch upon important points which can come in examination. So we'll cover Walker theory of profit, Clark's dynamic theory, Hawley risk theory of profit, Knight theory of profit, Schumpeter innovation theory of profit, wage theory of profit, and then socialist theory of profit. So this is the full syllabus as per IBBI exam curriculum of microeconomics, and it carries 3 marks. So consumption price mechanism, pricing of product, factors of production, up to this point we have already covered in session number 1 and 2. Link is given in description box below. If you have not gone through session number 1 and 2, I will not recommend to continue this session. Please go through session number 1 and 2, then please move to session number 3. So in today's session we are going to cover about theory of rent, interest, and profit. This part we have already covered: organization, profit, function of entrepreneur. So this is the part covered in session number 1. This part we covered in session number 2. So let us first discuss about what are the various theories of rent which is required to be studied from IBBI examination perspective. So these are the three theories of rent from IBBI exam perspective: Ricardian concept theory, modern theory of rent, and quasi rent theory. So Ricardian concept of rent, Ricardo assumed that the land, please note that in this theory land means soil only, is used to produce food grains only, and the soil cannot be used for any other purpose. So this is the assumption of Ricardian concept of rent theory. It further assumed that different pieces of land have different fertility and land cannot be destroyed, but its fertility can be destroyed. Please note down these assumptions. Sometimes one mark theory question may come out of these assumptions only. Thus, according to this theory, rent is that portion of produce from the land which is paid to the landlord for using the original and indestructible power of the soil. Rent is payment for use of land only and is different from contractual rent, which includes the return on capital investment made in the form of wells, irrigation structure, etc. on the land. So these are the two important principles of Ricardian theory of rent. So first principle is law of diminishing returns, that is the relative fertility of lands. And second one is Malthus's principle of population, that is law of supply and demand applied to the relationship between food production and population growth. As population grow, demand for food increases. As supply of food increases, food becomes cheaper and more children are brought to the world. So let us discuss these two principles in detail. So this theory, differential rent theory. So first principle, this theory is based on first principle of Ricardian theory. That is, lands differ in quality and fertility. Let us understand this theory and concept and principle with the help of an example. Say we have two pieces of land, A and B, and measuring 100 acre each. However, land A is more fertile than land B. as long as food produced on land A, which is more fertile, is adequate to feed the entire population of the country or economy. No one would like to cultivate land B because there is no demand of further food, and there will not be any rent for land A. As demand for food increases, land B will also be cultivated. So if demand for food increases beyond cultivation capacity of fertile land A, then farmers are forced to cultivate inferior land, less fertile land, which is land B. But land A will be preferred by farmers because of high fertility. But if we give a choice to a farmer, there could be a number of farmers in the market, in the economy. Everyone would like to cultivate farm A, land A, because it is more fertile and it will give more produce to the farmer given a level of effort. Thus farmers would be ready to pay rent to owner of land A over land B. So because there will be a demand of land A over land B. Those who will not be able to get land A, they will be forced to move, forced to cultivate land B, which is infertile or less fertile. So rent calculated using this theory is called rent under extensive cultivation. Please note down this terminology. Sometimes this 1 mark theory question comes out of this line only. Rent calculated using this differential rent theory is called rent under extensive cultivation. So this is an example to further understand the things. Say land A can produce a maximum of 35 ton of wheat. Land B can produce maximum of 25 ton of wheat. Area of both land is same and rate of wheat is 100 ton, 100 rupees 100 per ton. Say entire population needs only up to 35 ton of wheat. Since land A produces 35 ton of wheat and the same is adequate to feed the entire population, here land will not have any rent, which we discussed in last slide also. So if population increase and demand of wheat also increase to say for example 50 ton, then cultivators shall start cultivating inferior land, which is land B. So land B now can produce up to 25 ton of wheat. So out of 25, 15 ton of wheat will be produced from land B. Since land A produces 10 tons of extra wheat because of higher fertility, cultivators will give rent at the rate of rupees 100 per ton, which is rate of the wheat, plus 10 tons of excess wheat, which land A can produce over land B. Thus, rupees 1000 as rent for land A. So, just to conclude, thus rent is not price determining, but price determined. Please note down this statement. This statement normally many times it comes in IBBI exam 1 mark theory question. I'm repeating, rent is not price determining, but price determined. What does that mean? That is, price of food grain determines land rate. So here price of food grain has determined the land rate, and rent doesn't determine the food grain prices. So this rent doesn't determine the food grain prices. Instead, reverse happen. Whatever rates of the wheat has been occurring in the market, that will decide the final rent of the land. If all pieces of land are of same fertility, say land A and land B, both are having same fertility, then no rent would arise in the market. Second principle of theories, and based on the second principle, there is a concept of scarcity rent theory. So this theory is based on second principle. That is, if the land is of same quality, scarcity of land in relation to its demand gives rise to the rent. Ricardo calls it as scarcity rent. So this is also important terminology. Once entire land is being cultivated and additional demand for food grain arise, the cultivator will try to increase yield of already exhausted land by putting in more labor and capital. Say cultivator increases yield of land A from 35 ton to 40 ton by putting in additional labor and capital of say rupees 400. So this is the maximum capacity of land A, but farmer puts in some extra effort, some extra manure or some chemicals or some manure type thing, and by putting those efforts, extra efforts, labor and capital, the, the yield of the land, the farmer is able to increase from 35 ton to 40 ton, but he has to put in extra 400 rupees. Thus, assuming wheat price of rupees 100 per kg, land A will enjoy rent at the rate of 100 rupees. How to calculate? Because by putting this 400 rupees, the farmer can produce extra 5 ton, which is equivalent to 500 rupees. So this is the extra amount of yield the farmer, the cultivator, can generate, can produce out of land, multiplied by rate of the wheat grain in the market, minus total additional capital or labor or efforts the cultivator is required to put in to increase this yield of the land. This is rupees 100. The rule also apply to intensive cultivation. Also, since here farmer to increase the yield of same price of land instead of going for inferior land cultivation. So this is the second set of theory, which is modern theory of rent. According to modern theory of rent, rent of a factor from the point of view of any industry is the difference between its actual earning and transfer earning. So rent is nothing but is equal to, this is a numerical formula for calculation of rent as per modern theory of rent, and as per this theory, rent is nothing but equal to actual earnings minus transfer earning. What does that transfer earning means? Here transfer earnings refer to the amount of money which a factor of production could earn in its next paid use, the opportunity cost. Let us understand with the help of an example. Let us say 1 hectare of land under cotton cultivation yields an income of rupees, say 15,000 rupees. If the same area is being put into next best use, say paddy cultivation, and same 1 hectare can earn rupees 12,000 under paddy cultivation, which is under second best use, then rent of that 1 hectare of land is nothing but equal to actual rent from the cotton minus transfer earning. Here transfer earning means earning from the second best use, which is paddy here in this example. So that means 15,000 actual earning from the cotton cultivation minus 12,000 earning opportunity cost from second best use paddy cultivation. So that means the rent of this land is equal to 3,000 rupees. Please note that this concept is not merely applicable to land, but also to all factors of production. So here we have discussed, one factor, which is land. But as per this theory, this concept and this theory is applicable on all factors of production. We have already covered these factors of production in previous sessions. So please go through those sessions. Links are given in description box below. Labor, what are the other factors of production? Labor, capital, entrepreneurs earning too. This is the third theory of rent, which is quasi rent theory. So Dr. Marshall, please remember that this theory was coined by Dr. Marshall. This is also important. Introduce the concept of quasi rent in economics. It is just an expansion of Ricardian theory, that is Ricardian theory with respect to the specialized capital equipment or factors of production whose supply is perfectly elastic in short term. This elastic demand supply we already discussed in previous sessions. If demand of these specialized capital equipment increase, supply of these specialized capital equipment remain limited in short run. Being specialized machinery, these equipment have no alternative use. Thus its transfer earnings will be zero since it has no alternative use in short run. However, there may be some maintenance cost to keep it in running condition. Thus, quasi rent is also defined as the excess of total revenue earned in the short run minus total variable cost. So this is the formula. Quasi rent is equal to total revenue earned minus total variable cost. So next topic is interest and its types. So interest is the price paid for the loanable funds, which is nothing but capital, used in production process. So basically there are four factors which derive interest rates. So these four factors are very important from examination perspective. Many times 1 mark theory question come out of this slide only. So first factor is one saves money today by postponing his today's needs with an expectation of earning some return on the saved money in future. So I save my today's money and I postpone my today's need. I save that money with an expectation that I will earn some extra return on that same money, and that extra money along with income earned on that saving would be used by me in future. Second factor which derive the interest rate is after he lends the money, there is a risk of default. If I save my money and I lend that money to someone, there is always a risk of default. The person whom I will give my money, he may or may not return me back the money. Third factor, after he lends the money, the lender may need the money urgently, but borrower may refuse to make an early payment. Yes, there is a future inconvenience risk. So if I give my money on loan to somebody, there might be a contract of repayment that he will repay me back after 1 year or 2 years or 3 years, or will pay me back that amount into EMI of certain amount. But in case I need that money on urgent basis, so you may refuse that I not have that much of cash flow and I'm not expected to pay you that money before the commitment date. So that is a risk I'm carrying as a lender. And fourth factor is the lender need to maintain books of account of the borrowers, which again lead to some cost to the lender. Say I have saved 1 crore rupees or 10 lakh rupees. So if I have given, lent that money to 10 borrowers, 1 lakh rupees each. So I have to maintain a record of the lenders to whom I have given that money, if there is any security, what is the repayment history, repayment system. So I have to follow up with the borrowers for repayment of the amount. So all these things also need time and energy. So that also cost a certain expense to me as a lender. So these are the four factors which broadly affect the interest rates. So these are the two broad type of interest rates from examination perspective. First is gross interest and second is net, which is also called pure interest. So gross interest is nothing but it is the total interest paid by the borrower to the lender. And net or pure interest is the net interest earned by the lender after deducting default risk, future inconvenience risk, and admin cost from the gross interest. So what are the three? These are the three factors out of four factors which we discussed in the previous slide. So net or pure interest is equal to gross interest minus default risk, inconvenience risk, and admin cost. Sometimes 1 mark numerical comes out of this thing also. Examiner may give you these four data and may ask you to calculate pure interest, or vice versa also. Any of these five, out of these five, any four figures would be given in the exam, and examiner may ask you to provide the fifth figure, that is simple plus minus formula. Please remember this formula. Now, the third and last topic of today's session is theories of profit. So first let us understand what is profit. So an economic profit or loss is the difference between revenue received from the sale of an output and the cost of all inputs used, as well as any opportunity cost. So cost is sum total of input used plus opportunity cost. Please remember these three words. These are the 7 theories of profit. We'll study each one of them one by one in very small and concise manner within 2, 3, 4 lines from examination perspective only. So first theory is Walker's theory of profit. F. A. Walker stated that profit is rent of exceptional abilities that an entrepreneur may possess over others. So it is also called theory of profit as rent of ability. Please remember it is coined by F. A. Walker, and this theory of profit is pertaining to talks about exceptional abilities of the entrepreneur which he or she may possess over others. And this theory is also called theory of profit as rent of ability. Second theory is Clark's dynamic theory. Clark states that profit is a reward for inventing products and techniques of production and for managing the functions of entrepreneur under dynamic conditions. Profits is recognition of dynamic entrepreneurship. A static economy is defined as the one in which there is absolute freedom of competition, population, and capital are satisfactory. Production process remain unchanged over time. Goods continue to remain homogeneous. There is a freedom of factor mobility. There is no uncertainty and no risk. If risk exists, it is insurable. Thus, in a static economy, firms make only the normal profit or wages of management. However, in dynamic economy, these factors keep on changing. Third theory is Hawley's risk theory of profit. So it was coined by F.B. Hawley in 1983, and it highlighted that risk may arise in business due to reasons like obsolescence of product, unexpected collapse in the market prices, known availability of essential raw materials, risk due to fire, war, etc. Introduction of improved substitutes by competition, etc. Thus, F.A. Hawley referred to profit as the price paid by the society for assuming business risk. So this theory talks about compensation against the business risk. This is the key word in this theory. Fourth theory is Knight's theory of profit. Knight differentiated between calculable risk and non-calculable risk. This line is very important. Sometimes 1 mark theory question come out of this line only. Thus, theory of profit against all types of risk was coined by Hawley. However, Knight defined incalculable risk as uncertainty and referred that entrepreneur has to take right decisions in the region of uncertainty. Thus, he earns profit if he takes right decisions. According to him, calculable risks are insurable. These calculable risks have certain probability of occurrence based on their historic data, thus are insurable. So example of calculable risk are like fire, theft, accident. So keywords in this Knight's theory of profit is bearing uncertainty is the basis of business. So this is the key line or keyword from examination perspective. Please remember this thing, and also remember this theory differentiated between calculable risk and non-calculable risk. Fifth theory of profit is Schumpeter innovation theory of profit. So according to Schumpeter's theory coined in 1934, profit can be made only by introducing innovation in manufacturing methods as well as in the process of supplying the goods. So innovation in manufacturing process and supplying the goods, that is the keyword from examination perspective. So innovation can be of any of the following types. Could be maybe introduction of improved quality of goods, a new method of production, finding or developing a new market, discovery of new sources of raw material, organizing the industry more efficiently. in a new mode. So, according to this theory, the entrepreneur who innovates goes ahead to earn the profit. So, this is the gist of this theory. Sixth theory is wage theory of profit. An entrepreneur is just like a labor. According to this theory, an entrepreneur is nothing but a labor who puts more mental labor than less physical labor. The payment made for mental labor of an entrepreneur is profit. Seventh and last theory is the socialist theory of profit. The theory was coined by Karl Marx in his famous book, The Capital. Please remember the name of this book. Sometimes one mark theory question comes out of it only. He stated that capitalists try to exploit workers by paying lower wages than that of the wages considering their marginal productivity. He further explained that the value of a product is the sum of wages that should have been paid without exploitation considering marginal productivity. So according to this theory, profit is nothing but equal to value minus wages paid in actual to the exploited workers. So according to this theory, entrepreneurs, workers are paid wages less to their marginal productivity. As there is no exploitation assumed in social economy, the private profit will disappear, right? So this theory assumes that the entrepreneurs earn profit only by exploiting or paying lower wages to the worker, otherwise they will not be able to make any profit. So that's all for today's session. With this, we have completed our microeconomics playlist. So before I'm going to tell you about what we are going to have in our next session, I would request you to please subscribe to the channel and click on bell icon if you have not done till now, so that you will be intimated immediately about next session when we are going to upload. So next we are going to start a new playlist on macroeconomics, sorry, and it carries 3 marks as per revised IBBI syllabus: functions and role of money, inflation, type of inflation, control of inflation, deflation, savings, investments, components of economy, concepts of gross GDP, GNP, etc., definition of parallel economy, and real estate construction market. So all these things we'll try to cover in upcoming 3 sessions. So we'll try to cover all important aspects from examination perspective, and most probably you will not lose even a single mark into macroeconomics. Thank you.